Eric Ervin, it hasn't been that great a year for stocks. The S&P is only up around 1.6%. Bonds are no safe haven with the Fed ready to hike rates. But you say alternatives are the answer. Why is that?
I think that's exactly why that is the stock market's relatively toppy here. The valuations are pretty rich. Bond market doesn't really have anywhere to go. It's even in a best case scenario on a 10-year bond, you're going to only earn around 2%. And God forbid what you could lose potentially by investing in the bond market. So the safe haven of bonds, the return enhancers of stocks, really aren't offering those two things that they were so, supposed to offer. That's why we look to alternatives, not just alternative assets like commodities and real estate, but really the alternative strategies. So things that can produce alternative returns. For example, if you can just capture the dividends of the market without the stock price like our ETF divvy does, and that's the dividend growth, not the dividend yield, or other things where long and short strategies, things like that, places where you can earn a return in a sideways market or in even a downward-facing market.
Well, there's certainly a lot of liquid alt options out there. How do you choose the right one?
Well, I think this is the big problem is, as an advisor for 20 years plus to individual clients, what we found was there's so few good liquid alternative vehicles. They're really just a lot of high-priced T-bills. They're over-diversified, or they're trying to do a strategy that doesn't really fit into a liquid wrapper. But more and more, you're starting to see new liquid alternatives coming out. Like I mentioned, the divvy is our ETF. That's a strategy that is completely unique to any other strategy, and it offers this differentiated return. Again, something that's driven by reality, dividends, not necessarily stock prices, which are dictated by emotion. I think you're going to see more and more products that are going to come to market that are liquid, but are alternative.
But are there too many products out there? Because every time I turn around, a new ETF is being launched. It seems as though every benchmark is covered.
Yeah. How many different flavors of peanut butter can you have, right? That's the funny question here, is because most of the ETFs are truly just different flavors of the same peanut butter in a different package. It's not really differentiated. New alternative strategies, absolutely. That area is totally untouched and untapped at the moment. Think about when mutual funds, there's 15,000 mutual funds. There's only about 1,500 different ETFs. That's what we're going to see is more and more ETFs that are going to come into that space that are quasi-active, quasi-passive, but are going to offer that differentiated return.
All right, and then finally, what's your expectation for dividends in 2016? We're going to see a lot of companies raise their dividend, cut them. What do you think?
Yeah, we've had about 5 years, we've had exactly 5 years of almost double-digit dividend growth, which is unique because the average dividend growth is around 6.5%. This year is going to be roughly just under double digits. I think next year is going to be another 8% dividend growth year, and then probably the year after, and then we'll get back into that long run average of 6.5%, 7%. The beauty of that is stocks may do something completely different. In fact, we have an indicator that's telling us right now that next year is going to be a significant bear market. That's what I would worry about, is the stock price, not necessarily the dividend growth.
All right. Well, thanks a lot for coming on and
talking
about it. And thank you for watching The Street.